Everyone saw the number, 228 million, gone. And right now there are people buying this stock and people shorting it who are both dead wrong. Because this wasn't just a bad quarter, it was something else. Something most investors completely missed. If you think this is bullish, you're probably looking at the cash. If you think it's bearish, you're looking at the loss. Neither of those tells you what actually changed. And if you don't understand what really happened this quarter, you're not investing, you're guessing. So revenue is down and cash is up, but what does that actually mean? Here's the setup. Revenue dropped 18% year over year, margins shrunk, EBITDA went deeper into the red, and yet they ended the quarter with $391 million in cash. That's not a typo, it's the highest cash balance on the company's history. So what happened? They raised over $300 million in new equity, diluted shareholders hard, and flipped into a net positive cash position for the first time. In plain terms, they bought time, not traction. Now, here's where most people get this wrong. They look at the cash and assume strength, but raising money doesn't fix execution. It just delays judgment. The business isn't scaling, it's shrinking. Revenue is down, margins are getting worse. Guidance was lowered, and they pulled their full-year EBITDA forecast entirely. So if you're holding this thinking it's early in the AI cycle, stop. This isn't a growth story. This is a reset story. And resets come with one rule. You don't bet on the bounce until you see the rebuild. Most YouTube videos are full of fluff and hype. I'm here to break through the bullshit and give you the facts so you can make your own decisions. If I think it's great, I'll tell you. If I think it's shite, I'll say that too. I'm not here to sell a story. I'm here to tell the truth. So let's talk about the backlog. $380 million. That number gets a lot of attention, and for good reason. It looks like stability, visibility, future revenue locked in. But here's the problem. Backlog only matters if the contracts actually flow. And this quarter, one of their biggest Army contracts got disrupted. They lowered guidance, they pulled EBITDA forecasting completely. That's not confidence, that's damage control. Now let's get even more real. This backlog isn't diversified. It's mostly government, mostly defense, and highly concentrated. That means any delay, pause, or cancellation from a single agency can wreck a quarter. And if you think government contracts are safe, you've never watched Congress freeze a budget. So yes, $380 million in backlog sounds impressive, but don't mistake a pipeline for protection. Big Bear isn't sitting on a cash machine, they're sitting on a waiting game. And in this market, waiting costs money. BigBear.ai just wrote off $70.6 million in goodwill. That's not just a line item, that's a message. Goodwill is what you book when you buy a company for more than it's worth, because you believe in the upside. When you write it off, you're admitting that upside is gone. Now combine that with a $135.8 million hit on derivative liabilities, and this company didn't just miss earnings, they detonated their balance sheet. The write-down means they lowered their internal growth forecast. That's not market noise. That's them saying we're not as bullish on ourselves as we were last quarter. And this wasn't optional. This was forced by reality. So when you see a company torch $200 million in non-cash charges, that's not a footnote. That's a reset. And resets only matter if they lead to something better. Right now, all we know is what got destroyed. We haven't seen what gets rebuilt. BigBear.ai is burning through money, and the fire's getting bigger. Gross margin dropped to 25%. That's down from 27.8% a year ago. Adjusted EBITDA loss doubled, going from negative $3.7 million to negative $8.5 million. And they're still bleeding cash on operations. You don't need an MBA to read that trend. Margins are contracting, losses are expanding, and there's no signal yet that those lines reverse. Here's the real test. Strong businesses get more efficient as they scale. Big Bear is going the other direction. And if you're wondering whether the market noticed, they yanked their EBITDA guidance off the table completely. No roadmap, no confidence, no accountability. Look, cash buys time. We've said that. But if the burn rate keeps rising, they'll be right back where they started, except this time they'll have no story left to sell. And make no mistake, that's the clock they're on. Let's strip it down. Is this a smart long-term hold, or is this a coin flip with good branding? Here's the bull case. They're embedded in national security. That's a high-barrier, multi-decade sector. AI demand and defense is real. DoD and DHS are throwing billions into intelligence, automation, and situational awareness. And BigBear.ai is already on those contracts. They just raised enough cash to stay alive for years. That gives them runway most small cap AI players don't have. They're expanding globally, UAE, Panama, airport security, early moves that could pay off if they can execute. Now the bear case. There is no moat, no proprietary platform, no clear differentiation. Revenue is declining, margins are shrinking, and they're pulling forecasts instead of proving they can grow. Their business depends on government contracts, and those can vanish with one budget freeze. Dilution is already severe. Share count exploded from 251 million to 360 million. That's not growth. That's survival. And despite all this AI hype, they're still not profitable, not even close. The bottom line, this is not a long-term compounder. This is a very high-risk AI speculation play sitting on a pile of cash. You bet on this if you believe they can turn government access into scalable execution, and you're comfortable losing money if they don't. For me, this isn't a position, not until I see revenue stabilize, margins expand, and execution start matching the story. Until then, it's a high-risk speculation play with one thing going for it: cash and time. But time runs out fast when the burn rate's rising. That's the clock they're on, and I'm not touching this until I see them beat it. Here's the real question. Is the business getting stronger every quarter? No. Revenue's down, margins are shrinking, guidance was pulled. Are the numbers trending up across customers, contracts, and cash flow? Not yet. The backlog is big, but execution is missing. Is the product becoming harder to compete with? Not even close. No moat, no platform edge, just contract work in a crowded space. So what am I doing? Nothing. I'm watching. This isn't a stock you chase because it looks cheap. It's a stock you stalk because it might get interesting, if they prove they can execute with cash instead of just survive with it. My thesis on BigBear.ai right now is neutral with elevated downside risk. They bought themselves time, but they haven't earned trust. Not from the market, not from me. If they stabilize revenue, secure a long-term margin profile, and stop relying on dilution to exist, that's when it becomes interesting, not before. So until that happens, this stays off my buy list. And if you're holding it already, I'd be real clear on your time frame, your exit strategy, and your tolerance for volatility, because this isn't a steady compounder, it's a battlefield. And battlefield stocks require discipline, not hope. Let me ask you something. Who else is breaking down garbage earnings reports, exposing dilution and balance sheet bombs, and still showing you how to make money in this market? Who else is calling stocks like they actually trade them, not just reading headlines? Nobody. That's why my account is sitting at $6 million and up 72.04% year to date, with a full quarter left on the clock. And it's not just me. Richard just closed 5 figures in September, first time ever. Said it best, down to the excellent advice and support from this forum. Brandon grew from 89,000 to 113,000 in 3 months, pulled his first 5-figure month, and even missed a week of investing. To the moon, banged out 10,669 CHF, which is over 11,500 US, in profits in 1 month across 14 trades. This isn't hype. This is what happens when people finally get out of the guessing game and start using data, discipline, and a strategy that actually works. Inside my Patreon, you get real-time trade alerts, not just what I'm buying, but why. Daily analysis that cuts through noise, live breakdowns of what's working right now in this market, and access to the most disciplined community of execution-focused investors I've ever seen. It's $30 a month. People blow that on delivery apps and lose 20 times more blindly chasing Reddit tickers. This is the one thing that could actually pay you back. You want to know if this works? Look at the numbers, look at the results, then ask yourself, what's the cost of sitting on the sideline while others are printing cash in my group? Because here's the truth, you can scroll or you can scale, but either way, don't say you weren't told.